This video explores the way that interest rates rise and fall and how this relates to real estate. Central banks do not adjust interest rates based on the housing market, but rather they do so based on inflation. The government can stimulate the economy using two methods: fiscal stimulus and/or monetary stimulus. Fiscal stimulus is when the government injects money into the economy by spending money on programs. An example of fiscal stimulus is building a highway. Monetary stimulus is when a central bank adjusts the prime interest rate so that the companies and citizens borrow more and presumably spend this borrowed money in the economy. An example of monetary stimulus is when the prime rate is lowered after a recession has begun. The tendency to use monetary policy to keep inflation under control has become the norm because of major problems with inflation that persisted on and off over the past century. These inflationary problems were caused by many factors, including wars, lack of economic oversight, and increased government spending. In particular, inflation reached levels so high that some currencies were totally undermined and had to be replaced. Since the time when currencies were introduced centuries ago, it has been seen time and time again that governments tend to have a propensity to inflate their currencies by stimulating the economy in the wrong ways and/or at the wrong times. After the Second World War, Keynesian economic theory became the most prominent driver of government policy, and it tends to be used very heavily and predictably by most modern economists and governments. In a nutshell, Keynesian economics attempts to soften the effects of the regular economic boom and bust cycle by stimulating the economy during recessions and removing stimulus during economic expansion. Keynesian economic theory basically visualizes the economy like a car's engine. In this analogy, currency is the fuel, human resources are the engine's oil, and government is the driver. The engine can be accelerated by giving it more gas. It can be decelerated by taking the foot off the gas. It can be slowed down by applying the brakes, and it can overheat if there is not enough oil. This engine analogy and the car expressions are very frequently used by the central bank and by the news media to describe what is currently happening to the economy. With this analogy in mind, the central bank currently works according to its government mandate to focus on controlling inflation. Central banks are focused on keeping inflation at a very low target rate of about 1 to 2% per year, and they do this by primarily keeping a close eye on the unemployment rate. If the unemployment rate drops too low, this means that there is not enough slack in the labor market, and the economy is said to be overheating. When an economy grows too quickly, companies begin to notice that there are shortages of certain inputs, such as energy, raw materials, or workers. When there are not enough workers available to do the jobs that are necessary, companies are forced to raise wages in order to attract workers. And in the short term, this is considered to be beneficial. However, if this continues, then prices are driven up as well. The reason why prices are driven up so heavily by wages is because for most companies, the largest expense is the salaries of the employees. This wage and price increase can develop into a self-perpetuating cycle, where they keep rising at an exponential rate, and this is referred to as inflation. Economists visualize currency inflation like the inflation of a balloon. A balloon that is filled with air appears to be growing, but the balloon itself is still very small. It just appears to be getting bigger because the air inside of it is stretching it into a large round shape. When there is too much air in a balloon, and it cannot stretch any further, it will pop. When the balloon pops, it becomes very clear that the balloon was not really growing at all, but that it remained basically unchanged since the inflation began, except that it got damaged in the process. When an economy is experiencing inflation, everyone makes lots of money, but prices are so high that the money isn't technically worth as much. The nominal wages seem to be very high, but in reality, the real wages are a lot lower. This phenomenon will snowball and get exponentially worse until the government is forced to respond to it due to public outrage over the debasement of the currency. In some countries where the governments let it get too far, citizens were forced to use foreign currencies, or even bartering because the currency had no value. The expression, "that's not worth the paper that it's printed on," comes from countries that had hyperinflation to the point where it cost more to print the money than the money was eventually worth. In all cases, hyperinflation results in a collapse of the currency and usually a change in government. But fortunately, due to the efforts of central banks, this has been avoided in the developed world for several decades. Alan Greenspan mentioned in his book, The Age of Turbulence, that during his long tenure, regardless of whether the president was a Democrat or a Republican, there was always enormous pressure from the politicians for central bankers to stimulate the economy by lowering interest rates. Fortunately, the central bank is independent of the executive and legislative branches, and so they are able to act in the interest of the currency and the economy. So when will interest rates rise? The unemployment rate is inversely related to inflation, and so the question of when interest rates will rise can be answered by first determining when the unemployment rate will drop. When the economy is overheating, inflation will begin to rise, and it is at this point that the government will begin to remove stimulus and then apply the brakes in order to quote-unquote cool the economy. When this decision is announced, everyone will understand that interest rates are rising and they will move their investments away from riskier assets like the stock market. Investors will tend to move their money out of stocks and out of the developing countries back to the United States, where the increased interest rates will provide better return with lower risk. As a byproduct of this segment of the economic cycle, the side effect is that house prices may not be able to continue to rise because the rate of return on these investments will not be high enough to cover the higher borrowing costs. This means that when the economy heats up too much, interest rates will need to be raised, and this will put downward pressure on house prices as well as the stock market. Asset values will continue to experience downward pressure until it is noted that the economy needs to be stimulated once again. When the world is convinced that governments are acting together to stimulate the global economy, confidence in the markets will be re-established and prices will rise again. This will happen when it is known that the interest rates will be lowered. Lowering interest rates means that it will be slightly cheaper to borrow again, and therefore more lucrative to invest in risky assets like stocks. This process is basically referred to as the economic cycle, and it continues to repeat itself time after time, approximately every 10 years. It should be noted, however, that historical behavior can never guarantee the future trends, and so nobody truly knows the timing of how the business cycle will play out.